guys. Today we're going to be discussing how to analyze management in a company, which is a very important part when coming to choose equities, basically. And this is going to be a more friendly flow episodes, other than discussing numbers like the previous two episodes, which were quite heavy, but required. That's basically it. I mean, we're going to be discussing management, and that's why I'm here today. So we start off, guys. So I think one of the main points that we should start off with is management is key to choosing a company. You know, when you come to choose and buy a stock in a company, the management are running the business. So they would have had a track record, and they're going to be the ones who are going to push the business to the point X. So how would you guys analyze management?
To start off, I would say one of the most important things is really to look at their track record. And I mean, a lot of people might just look at the stock price during the period in which they were a CEO. That could be reasonable, but it's not the best thing you can do. So you need to look at the underlying performance of the actual company. What are they actually doing there? What are they prioritizing? I think that's quite important. So if you have to look at something like return on assets, that's ROA, the ratio is called. If you look at it over time and see when they came into the company, did they manage to improve it? Are they managing to improve revenue growth? Things like this, they're spending more on R&D. That's attractive. Things like this, I think are very important. And even if it's a CEO coming into the company, it's important to look at what did they do in previous jobs.
Another very important part, obviously it's very, very important to have, checking out the CEO and seeing what their previous experiences are, alongside other sort of board members. So you have chief technological officers in companies which play a big role today, the CFOs. And it's always very good to ensure that there's a good level of diversity, I think, on the board. So especially if a company has complex operations, so for example, a tech company or a fintech company, I think it's very important that you check sort of every single board member and see how they may contribute to the overall plan of the organization to achieve its long-term goals. So, for me, I think diversity is a very big point. And I also like to check from my end is see how the organization has been unloading debt over the past, over the term of, say, the current CEO. And the reason for them unloading debt, I think it's a key point for them to ensure that the organization is in a good cash position, in a good liquidity position in the future to meet its long-term targets.
When you are talking about diversity, Steve, so diversity in terms of what are we looking at exactly?
So I think it's different backgrounds. So a person, obviously, you wouldn't want too much of the same people on the board. Otherwise, you compromise sort of the whole efficiency in the way the board tackles different problems they have. So I think having a more diverse sort of board with different experiences behind them and coming from, working in previous organizations and, having X experience, they might add, value to the current board of the company which you're currently looking into investing in.
Yeah.
I agree totally. One question I would like to ask you guys, and I think it's a question we get a lot on the group, is basically how can you know how humble CEOs are, or how can you learn about integrity of the CEOs? Because it's like you know this guy personally, or you know this woman personally, and you're it's how can you find that out?
It's difficult. I would say the way, first of all, you can not really interact, but just get a bit of a feeling on these CEOs, because the only contact you have with a lot of CEOs is you look at the financial statements and it says our CEO is this and this is what he thinks about the company. So what you can do is you go on the investors page on the website and you go on the webcast. So on the webcast, that's where they start talking about their annual results, and a lot of investment analysts start asking them questions. And a lot of times they're quite difficult questions, so seeing just how they react to those questions is quite important in my opinion. You can also look at YouTube videos and any sort of media attention they get. It's difficult, so I think you just have to kind of get a feeling for the person and the way they talk. So it's quite maybe a bit of a harsh judgment over there. I would say maybe the best thing you could do is look for previous, for evidence from previous experience. So when they were in a hard time, did they do something that was maybe a bit unethical, or did they go for, did they just bite the bullets? See, when there are hard times, I think that's when the true character comes out of the management.
I completely agree. I think actually YouTube, even just hearing into the webcast of an organization, are a really good way of getting a feel of the way the sort of CEO speaks to the public. At the end of the day, it's quite a daunting task to project what a company is going to do in the future, especially when the questions are very hard and very detailed. So if a CEO tends to divert from their overall from the question in hand, then it might be a bit of a red light, I think. Yeah. Another good point is that they're very vocal today on social media and also on YouTube and so on and so forth. So it's quite a good way in which a person can sort of tune in and hear the way a CEO speaks. At the end of the day, he's communicating to you as a shareholder. So I think it's important to stay in tune with that.
For sure. Yeah, I think integrity is really just the most important factor for management, because you only have limited information on what a company is doing. So you really need to trust that behind the scenes, everything that's going on is being done smoothly in favor of the shareholders. So for example, I know a study that shows that if a company has a CEO who buys a private jet for the company, that company significantly underperforms the market. So even if, let's say, it's for a massive company where just a private jet is something as like a small expense, it's actually just a symbol that shows that the CEO is there not in particular to increase shareholder wealth, but he just wants to maximize his own benefit, So he buys himself a luxury plane, he pays himself too high a salary, things like this.
Wants to live the lavish life.
Exactly.
Yeah. And basically through social media, you can find that out really easily. I mean, you just go, like most of the younger CEOs, they all have social media. And even some of the older ones, I mean, they have to be there. They have to put their face out. And through social media, you can realize like which ones want to live the lavish life and which ones are just really focused on what they actually want to achieve. Yeah. I think one of the other things that like when I read to the financial statements and the documents on the investment relations page, basically you find out which CEOs or board of directors have shares in the company and what type of salary they have and how is their salary tied to the whole organization. I think that's an important factor, no?
Yeah, definitely. I think this links very much into the previous argument of whether they're there just for their own benefit or for the shareholders' benefit. So what we see is when we compare companies where the CEO has a massive shareholding in the company, and we compare that to companies where the CEO earns most of his money through a salary, the ones where the CEO has a massive shareholding significantly outperform the companies where they don't have that shareholding. And the reason is because if you have a massive shareholding in the company, then it's a move higher in the share price is going to give you a lot more money than your salary and your bonus can ever give you. So you don't have that conflict of interest where you're trying to get for your own benefit. Your own benefit becomes the shareholder's benefit because you also want to increase the shareholder value, because at the end of the day, you want the big shareholders. However, a lot of companies, we see that the CEO might not have a big shareholding, and he gets most of his money through a salary and even more from a bonus. So what he's trying to do is make everything so that he maximizes his bonus, and whether he makes value for the shareholder or not might be a bit irrelevant at that point.
Yeah, I think that's actually a very good point. When analyzing a company as well, I think it's very important that you understand sort of what the financial figures are actually saying. Because the management CEO can always come on television and say he has extremely good plans, which is going to affect the share price in the short term. And that might also be to their own benefit. So they're edging towards their end of term and power of the organization. They come on TV, say that the organization has great plans. And it may not necessarily be the case, just to benefit the last sort of for the CEO to take as much as he can in his last few months or years in power, and then once he's out of there, ciao and bye, that's finished. So I think it's very important that an investor actually analyzes. So for example, why an organization is taking on this debt, the financial health of the organization, the profit margins, if the profits are increasing. So like that, you kind of, the management's opinion is solidified by actual factual figures instead of him just coming on and saying, hey, this company is going to be massive in the next 5 years, and then next year he resigns, and then that's it,
Yeah, and it links quite a bit into their salary as well, right? So what is their salary? CEOs have a bit of a different structure to us normal workers. They have a base salary normally is less than half of their total salary, and the rest is all bonus. Now, this bonus is normally tied to a lot of operating metrics like profitability or cash flow, things like this. So it's important to see what it's linked to, because over there you can find these in the financial statements, by the way. But what you start to see sometimes is that there are metrics that don't really put the interest of the shareholder first. So, for example, once I saw a company where their bonus was linked to earnings per share. However, it was capped. So, for example, their bonus keeps increasing until the earnings per share is 10 euros. And then if it's more than that, if they get 11 euros earnings per share, they don't get any further bonus. So the shareholder has no incentive to increase the earnings as much as possible. They'll say, you know what, I'm going to hit 10 euros exactly this year, so that next year I can realize the growth. So in that sense, let's say, imagine they have a bunch of possible sales coming in October, November, December. They say, you know what, I'll put them off for now. I'll throw them in next year, so that next year I can also get the growth and also get my bonus. So I think maybe what's nice to tie your bonus to is things like long-term revenue growth, free cash flow generation, it's called, and even return on invested capital. Those are some operating metrics that are, I think, quite key over there.
So basically, like they would put off the earnings of this year to reach your targets in, like, because I mean, let's say you're an Amazon, you sell much more in the Christmas period than in the March period. Yeah. So they would put off earnings from March just to achieve the. It makes total sense. One last thing I would like to go to is how innovative is the management, and have they been there for a long time? One thing, me personally, when I invest in companies, usually most of them are co-founder led. So the co-founder would have started the company, the founder would have started the company basically, or a co-founder, and they would still be there managing the company. I really like that personally, because I believe they have a genuine interest to improving the company, and they actually have, how can I say, feelings towards the company. This is something I think that you should know about the company. So in terms of have the management been there for a long time, and how innovative is the management around, and are they external hires or even internal hires in terms of the board of directors?
Yeah, for sure. I would say something like on innovation, it's important to see, to gauge it. You can look at how much are they spending on research and development as a proportion of their revenue compared to peers. So if you look at something like Apple worries me a bit in the sense that they were very innovative when they came up with the iPhone and the Mac and all their other stuff. But recently, with Tim Cook as the head over there, they haven't really done much. I mean, the innovations they've been doing are just getting out the latest iPhone with a small thing changed. And I mean, fine, they're good products, but if you don't come out with anything big, eventually could it come back to bite you in the ass? And that could be the case. I'm not saying it's going to happen, but it's a risk if you're not seeing any innovation, especially from companies led by innovation. However, having said that, it's a bit of a change, because I heard Tesla was getting into cars. It's a bit different. Yeah.
There's another point. I mean, kind of like dividends comes around as well when it comes to sort of how much management is willing to innovate. So in the tech space, if you're in the tech space, obviously you are in a hyper-competitive market, and you always constantly need to re-innovate to make sure that you remain sort of competitive in that market. One of the good examples of this, I think, is Intel, who up until recently were giving out loads of dividends to their shareholders. And then AMD came around, was one of this really, one of the most innovative companies within the space. They kept on spending on research and development, and eventually they started cutting into Intel's market share. And eventually, sort of there they are, competing with Intel for market share on an equal level. So I think from a management point of view, I think depending on the industry, it's important that you analyze whether or not the management is really focusing on research and development, sales and marketing, and future expansion within that organization, because that will generate future cash flow for it.
Yeah.
Totally. One last question I would like to ask you guys, and I would know your opinion here. How important do you think that analyzing management is on a scale of 1 to 10 when deciding to buy a stock or buy an equity in a company?
For me, I would say it's 10. It's one of the most important things. I would say what you're trying to do in the long run is you're trying to choose someone who can, I would say, manage the assets in the most efficient way. And they all talk in a very nice way. So like when you hear them talking, you say, wow, this guy's a genius and he's doing very good stuff. And he might be doing very good stuff, but at the end of the day, I run under the impression that most people lost their kids in an adult body. So you'd be surprised that the small things that might be clouding their judgment, even just emotional, irrational things, So a lot of times you might even see management that they just want to grow because for personal ego reasons, they want to have this big empire that they're running. But because of that, they grow recklessly. They expand in areas where it's just not going to be profitable, So I would say that this is the key thing. And especially because management is something that you can get just a bit of a glimpse on, but it's very difficult to analyze. So the more difficult something it is to analyze, the more benefits your stock can have if you get it right compared to other investors.
Or the opposite, if you get it wrong, it might be like...
That's true.
And you, Steve?
Yeah, full agreement with Steve. I think management are basically the people who direct the company towards their future goals. So if a person is compromised by self-interest and they want to, live this lavish lifestyle, then their full interest isn't within the company, and the company's long-term objective is within their own personal benefit. And the people who are going to suffer are going to be the shareholders in the company. So management are, up there with the most important things you should be looking at.
All right.
Yeah.
Very, very interesting, guys. That's all for today. If you have any questions, leave them in the comment section below, or just join our group and ask over there. Thank you, guys.
Thanks.